Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from Miami at the Exchange ETF conference. Joining me for this segment, we have Dave Braun, Managing Director and Portfolio Manager at PIMCO, to discuss the changing role of bonds. Dave, it's great to have you with us. Welcome to Trade Talks.
Thanks for having me, Jill.
And that really has been a big topic, is fixed income this year at Exchange. What economic themes does PIMCO foresee in 2023, and what are the implications of these?
Yeah, great, thank you. So we believe inflation has peaked. You're starting to see some pretty strong declines in inflation. And that gives the Fed the air cover to get to their destination, maybe another 25, 50 basis points of hikes, and then hold policy there at that restrictive stance. Their goal is to sidestep a recession, and you see strong labor markets, you see inflation coming down. That is a possibility, although our base case is for a mild recession in the later part of 2023. And that will be the consequence that we have to endure to get rid of inflation and hike policy like we are.
Clearly 2023, bonds are back for sure. What advice do you have for investors that want to take advantage of today's high yields?
Yeah, so after the worst year on record in bonds, everyone's kind of spooked and afraid of bonds. But the beauty of bonds is bond math works, right? So bond funds were down so much last year because of the rise in rates. Not just the rise in treasury yields, but also in spreads. And now, from a forward-looking basis, that's your initial starting yield on a bond fund. So in our mind, the pain is done. You're starting to see some of that come back, and the bonds are up for the year. But the starting yields are very attractive. We're looking at high-quality bond funds with 5 to 6% starting yields, which is the best they've looked in decades.
Right.
And you don't really have to be a hero and reach for lower quality parts of the spectrum or go outside the US. You can build a high quality bond portfolio, like I said, with a 5 to 6% yield on it.
What do you see as the advantage for active management as it relates to fixed income funds?
Yeah, so obviously at PIMCO, we're diehard believers in active management. What we like about active management is you're not tethered to a benchmark. So if you're following benchmarks, you're stuck lending to those who are deemed benchmark eligible by the index providers. There's often a halo effect when a credit security is benchmark eligible because so many buyers have to buy it to reduce their tracking error versus their index. We're not tethered to that, we don't have to. So we go where the opportunities are. We can pursue more attractive risk-adjusted returns by going outside of benchmarks to source our credit risk. And then the other thing is, as an active manager, you can be dynamic in how you trade it. You're not always just like, 40% in more treasuries, 30% in mortgages, 30% in corporates. You can move those weights around as you see relative values shifting in the market, which we think is important given the uncertainty that's ahead of us. There's going to be opportunities to take advantage of those opportunities by moving the portfolio around.
How have you seen the ETF landscape changing as it relates to the bond space?
Yeah, so bonds are like the younger sibling of equities in the ETF landscape, right? Like the ETF world started with equity funds, and a lot of folks still associate ETFs with equities, and bonds are kind of the newer, younger version. But if you look at hard data, how many fixed income ETFs were launched last year, and in particular, how many active fixed income ETFs were launched last year, you had new entrants to the market who historically had stuck with 40 Act mutual funds. And then you also look at the soft data, like someone popped up a poll of the FAs in the room, and a lot of them are showing much more interest in learning more about active fixed income in the ETF landscape. So at PIMCO, we're vehicle agnostic. We think we have a very good investment engine, and if people want that in a 40 Act mutual fund or a separate account or an ETF, that's what we're trying to deliver. So that's what I'd say about that.
Yeah, well, it's interesting because that really has been a key theme, is the ETF wrapper around fixed income. There's so much advisor demand. They need help structuring that, where structuring bonds can be pretty complex. You put it in the ETF wrapper and it just helps them with
exactly.
their portfolios.
Yeah, and we think perhaps historically people just assumed a fixed income ETF is going to be passive, and that's not the case. You look at more of the launches have been in active fixed income. More of the demand from end users is active fixed income. And that's what we're very optimistic about the future of active fixed income ETFs.
All right, Dave, appreciate the insight.
Thanks
for joining us
much
on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.